Hello and welcome to a market update and a fund update with SKAGEN Global. Today we're going to talk about the following items. We'll go through the fund and the market development, a case study with Relics, the big tech capex, changes in the portfolio, the US exposure that we have, and then outlook. But before we kind of dive into to the first agenda item about the fund and the market development, it is a time of high volatility currently in the market with the US attack against Iran. And we have received a number of questions on how this impacts the market in the short term and the medium term. Now, our view on this in the short term is that we're going to continue to see likely more volatility in the market. Things are, of course, unpredictable, but on the other hand, this attack doesn't come as a complete surprise, given that we've seen a buildup of assets in the region over the past few weeks. But things are, of course, unpredictable in this type of armed conflicts, and something could happen that could have implications over the longer term. So again, it's hard to make any firm predictions. But if we kind of draw a parallel to what happened last summer when the US bombed the Iranian nuclear assets, then the oil price, which initially shot up, it came back down again and was basically back at the same level within 2 weeks of that attack. So we could see something similar this time here, but it could, of course, also take a different route. So from our perspective, it's important to kind of remain pragmatic, and our portfolio is built to basically be prepared for a lot of different events, including geopolitical events. So we're not concerned with what we have seen. We think that our holdings have relatively limited exposure to what's going on in the Middle East. But we are on the lookout if there's any sort of panic selling that could open up an opportunity for us to maybe pick up some other holdings. So we'll continue to monitor the situation closely as we look forward. So with that initial comment, kind of let's dive into the market here and the fund's performance. On a general level, what we have seen so far in 2026 is that assets or stocks that have been connected to digital business models have seen significant sell-offs in many, many cases. These can kind of be thought about as a 3D, the digital kind of names on technology. On the other hand, stocks or companies that are more involved in a two-dimensional world, so that would be companies like miners, oil and gas companies, industrials, places where you can't have an AI app or robot or an algorithm come in and disrupt what you're doing easily. They have seen a re-rating, and they have been sort of the side where they're seen as a safe haven that have been trading up. If we put some numbers to this, we go on here and we kind of look at the MSCI World All Country Index. This is for the first 2 months of the year. Like I said, in green here, you have energy, material, industrials being the best performing sector so far. And in the bottom, we have consumer services, which is largely technology. We have information technology, some of the finance or financial names, and this consumer discretionary being sort of on the loser side. Now, on this graph, it looks like the difference is large, but not huge between sector performance, looking at the best compared to the worst. But this masks some of the underlying dynamics, which are more visible if we go to a kind of a subsector level. Now, this is a different index. This is the S&P 500, where we have a very granular view of things. And then again, like I said, we can see that the oil and gas, construction and engineering, copper, agriculture, those are all doing very well, up nearly 30% year to date. We also have, of course, the semiconductor equipment, the data chips that are being purchased in all this sort of big AI build out and data center build out that we'll touch more upon later. Now, then in the bottom here, you can kind of see the strong or this large underperformance in other groups. We have, again, the software sector has been extremely weak. We have broadcasting, application software, again, down kind of in the high 20s in terms of percentage. So here you can kind of see the discrepancy, and a lot of this has been driven by the fear of AI coming in and interrupting big part of the digital universe. In our view, this sell-off that has been happening and presumably caused by the AI fear has been indiscriminate. We have seen what we would characterize as almost panic selling across sectors where everything has been sold down, regardless of the underlying fundamentals of the businesses. And we think this has been driven in large part by indices, ETFs, where you have companies collected in one ETF, and if that whole ETF is dumped by large capital flows, everything will go down. Looking then at our fund, where performance has been weak year to date, we have seen a clear hit in these names. These names, so here in the red circle, are names that rely on largely digital business models. It can be that they own proprietary data. It can be that they sell digital tools, and they also include the payment companies. They have insurance brokers, stock exchanges. So we think it's actually a very diversified mix of companies that are using technology to their advantage. However, so far in 2026, anything that has included this type of technologies has been seen as very vulnerable to disruption by AI. On the other hand, some of the big names, kind of the big tech names that we have been seeing a lot of talk about over the past decade that have done phenomenally well, they have also struggled in some cases. And here we can see a different reason why they have been struggling in the market, although they haven't gone down by the same extent as these other companies. And we'll come back to why that is. And then last, it's worth pointing out, like I said, that the 2D, kind of the physical assets, companies relying on those have done well. In SKAGEN Global, we have a number of these boring giants. For example, we have Waste Management. We have the freight railway operator, Canadian Pacific, which has done pretty well so far in this year. And they have been holding up well, but given the large magnitude of the pull down from these other technology names, the performance has been, of course, negatively impacted by that. Now, in the next section, when we talk about that, we think this is overdone. We don't think that it's an indiscriminate sell-off, that is disconnected from fundamentals. Let's kind of go through a case from the portfolio, from the fund, to illustrate why we think that there is good reason to have this type of logic. The case here is RELX, which is a company that everybody may not be familiar with. So just to say a few words on the background of the company, it is a company headquartered in the UK, but it has an international reach. Market cap is 50 billion euros, so it's a fairly large company. Also, you can see 40,000 employees, so clearly a sizable player in the global universe. RELX has been around for decades, and what it does is essentially that it nowadays a company that has a lot of proprietary data. So it offers a proprietary data and digital tools to customers in different segments. In risk, you can see here in green, it sells data mainly to insurance companies that help these insurance company price their policies and their risks in a better way. They also sell legal proprietary data to legal firms, for example, lawyers who want to prepare a case for the court. And then they have STM, which is basically a collection of the best scientific journals in the world, where they have the digital repository, and they also sell this to libraries and universities and other agencies. So that kind of gives you a bit of a background that it is, of course, a company that has digital tools, digital data, and has been around for a long time. Now, what has happened to RELX? This is a graph of the share price. It goes back to 2021, and you can see that the share price has been climbing nicely over time. That is because RELX has launched new products, and they have taken market share. They have increased the revenue growth over this time period. However, since mid of 2025, the stock has been on a sharp decline, and in fact, it's been declining by 49% until kind of the early part of 2026. And as you can kind of see here to the right, the first 2 months has been especially painful, going from 35 to 25 in the stock price. This has been very much kind of sparked by the AI worries, especially the Anthropic launch that was discussed in the media over the past few weeks extensively. So when we think about this, kind of what is background and what is happening here? I mean, is the company gonna go? Is it gonna be outcompeted by AI? Is it gonna make less money? Why has this been such a big pullback in the share price? Well, if we look at something called the PE ratio, this is a forward PE ratio going back 10 years. You can kind of see a similar development as the share price. It's been rising gradually, but then it's been falling off a cliff essentially for the past 6 months or so, going from 29 times to only 14 times in 6 months. As you can see from the graph, it is now kind of trading at the lowest point that you've seen in over a decade. Okay. That would, of course, illustrate that there is something threatening the company. But if we look then at the estimates, this is the analyst estimates of how much money the company is going to make. So the earnings estimates for 26 in blue, 2027 in orange, and 2028 in purple. You can kind of see that the earnings estimates are going up with each year. If you kind of squint, you can see on the graph that the company is expected to make about 10% higher profit each of the following 3 years. So there's no indication whatsoever that the company is going to make less money. In fact, you could see that given this increase here at the right-hand side of each of these estimates is going up, indicating that people or the analysts or the market actually seems to be more positive on the company. I mean, arguably, it could indicate that the RELX will be able to use AI more efficiently than other companies and therefore crank out a higher profit. So this is very kind of counterintuitive compared to what's happening with the share price. And then as another piece to the puzzle, when we look at the management team, we have the CEO here on the left-hand side and the CFO on the right-hand side. What have they been doing during these times? Well, the CEO, his current shareholding is worth around 30 million pounds. Okay, that is after the stock is down nearly 50%. So it's been very painful for the CEO of RELX. But if we look at what he has done, look at this kind of green dotted line in the graph that shows his ownership of stocks that he has in the company. And here is telling that it's going up. Actually, it's even an increase here in 2026. So he is accumulating shares. If he is seeing bad signs in the business, he probably wouldn't be buying or accumulating shares, But again, it looks like he is pretty positive on the outlook of the company. And the same trend can be seen for the CFO. Yeah? So again, this is not a guarantee, but it is one indication, one more indication that things are actually looking good for RELX in contrast to what the share price is signaling. So then if kind of sum things up here and we look at the kind of another couple of pieces here for RELX, they presented their financial results here earlier in February. They were good results. They were a little bit better than we had expected. The company also increased the buybacks by 50%, 50 for 2026. We look at that as a testament to the company's conviction that the stock price is severely undervalued, given that they are increasing the buybacks, taking advantage of this big dip in the share price. So we interpreted this the same way as RELX management and board, in that we have been buying RELX in the fund. We kind of see it as one of these rare opportunities to buy a very high quality company that is suddenly on sale for no logical reason. This takes RELX to a top 3 position in the fund. It is about 7% position size currently, and we see at least 93% upside and a pretty limited downside at these levels. So that looks very compelling. And the stock has been starting to climb back. It's up about 24% since the bottom in mid-February. But given the big share price fall, there is still a long way to go for RELX to make up for what has happened here. So hopefully that gives a little bit of kind of the reasoning behind what we have done in RELX, and it's also an indication of what we have done in other companies, depending on, of course, our conviction in the company. In the case, we may not take every company to a 7% position, but we will gradually add to companies where we kind of see a similar dynamic and where there's no logical reason or explanation for the fall in the share price. Okay, so that's kind of true for most of these companies that we circled in the previous slide, technology companies that have been swept up in this indiscriminate selling that has been going on. On the other hand, we think there is a different story and different conclusions when we talk about the big tech names. These are the Mag 7 companies that have been discussed for a number of years. What we have seen during the reporting season for these companies is that they have been announcing very sizable increases in their CapEx numbers. Okay. This graph shows you the CapEx by company from 2024, 2025, and then the projections going forward. And this is a big change compared to what we have seen in the past decade, because it used to be that these companies could grow revenue, could grow earnings with relatively modest investments. So they were very efficient from a capital point of view. Now, when they have to spend these sums and sort of in aggregate, we're looking at a sum over 700 billion just in 2026. The picture changes somewhat. And the reason is that when we begin to add up these investments, and these are investments mainly in data centers going forward, that it's not obvious to us that there's going to be a sufficient demand to guarantee the company to make a high return on capital for these huge investments. So to us, that is a concern, and we think that there is some element here of FOMO, fear of missing out, meaning that if one of these companies is announcing big capex, the other ones want to follow suit to make sure that they're not left behind in the AI market. So that's something that is been driving our thinking around reducing positions in these companies. You can sum up the concerns in these 4 different categories. Number 1, overcapacity. That's what I just sort of mentioned about maybe too much of a build out given that the demand remains unproven. We don't know how much AI is going to be able to actually generate in terms of revenue for these companies. And it reminds us to some extent of previous big build-outs in history. For example, the railway mania back in the 1800s, the telecom bubble with all the fibers being overbuilt across the nation, the shale revolution, and now we have the AI euphoria. So that's kind of one concern that we have. The second one is about circular investments. This is a very busy graph, and it is for a reason, namely that there are a dozen or so companies that are making investments in each other, kind of driving or fueling this investment mania. And we have seen that in previous cases, and in those cases, it did not always end well. So it is another red flag that certainly merits further monitoring going forward. And then number 3 is about debt. These big tech companies, they are cash machines. They generate tons of cash. They didn't used to have any debt on their balance sheets. They were net cash for many years. Now, given the magnitude of these capex investments in new data centers, they are beginning to take on and issue debt. For example, Google just issued a 100-year bond the other week, something that they have not done in the past. Meta, they use off-balance sheet debt to basically have some of their debt showing up off-balance sheet in a way that the balance sheet that the company controls and which is used by the rating agencies to put a grading on the debt is kept cleaner, but it doesn't hide the fact that you have more debt being in the system. And that's another thing that we think is slightly worrying, not hugely at the current level, but the direction of travel is going in a way that we are not as uncomfortable with as we were when they were big net cash generators. And the last point, power supply. This debate did not exist in the market a few years ago, but given that a single data center consumes as much electricity as a small city, people are beginning to notice that the electricity bills are going up rapidly, and more likely than not, the big tech companies are going to have to find ways to deal with this. Maybe they have to pay more for their own power. Maybe they have to build power plants. Maybe the regulatory burden is going to be more stringent. So this is another concern that just adds to the complexity and a higher risk of operational hiccups as we look forward. So kind of putting this together, and that's a good transition into the next section about portfolio changes. If we start kind of what we have been reducing in the fund, the red arrow, it would be the big tech names. Yeah, just like we described, here we're seeing a shift in fundamentals. We don't think they are as attractive as they have been in the past, and therefore we have taken down this exposure in the fund. On the other hand, as we described initially, and the case study with Relex, these companies on the green side, they are companies that we think have been sold down indiscriminately. It's been an unjustified derating of many of these companies, and we have been making selectively, we've been adding to the position sizes in several of these cases, and there might be more to come on that one. Then also, of course, given what's been happening in the market, the volatility, we have seen opportunities for new holdings, and we are currently building position sizes. We haven't finished building them yet, so we can't say which names they are, but we are adding some fresh blood to the portfolio, and we will be excited to describe them in more detail once we have finished building those positions. We also get some questions about the US exposure in the fund, given what's going on in the political arena, and also in light of the dollar that has been weakening quite a bit against many currencies over the past year or year and a half even. So here's a kind of a view showing you the exposure for SKAGEN Global, and this exposure is based on where the companies in the fund derive their revenues. Okay, so it's not where they are listed, it is where they have their sales take place. So with this as an approximation, then we have 49% in the US, 9% in Canada, 20% in Europe, and 7 plus 1 plus 14, so 22% in the rest of the world, meaning Asia, South America, Australia, a little bit in Africa, and some in the Middle East. Yeah. So we think this is a pretty good balance across the globe, and we're not trying to steer the portfolio against a certain figure on each continent. It is more of a residual from the stock picking that we do, but we do keep an eye on to make sure that it is at least a reasonable balance between our different geographical components. Then moving on to the outlook for the fund and for the market. And remember how we talked about RELX, and we talked about this derating, the multiple, the PE multiple going from 29 to 14 in 6 months. That's true not only for RELX, but it is sort of something that you can think of as a spring. You know, if the multiple goes down, compresses, it's like pushing a spring together. And as long as the fundamentals are intact and as long as the starting point was reasonable, the spring is likely to rebound, to bounce back again when things normalize or when sentiment becomes less negative. On this graph, it is another PE ratio, but this time for what's called the financial data providers total return index. So this is an index, an ETF essentially, where you have many of these technology names that we highlighted earlier. Yeah? So the stock exchanges, insurance brokers, the data providers, they tend to be in this index. And this index, as you can see from this graph, has been sold down sharply in the past. 2015, I think it was early 2016, we had the China slowdown scare. We had an inflation scare at the end of 2018. We had the COVID scare. And in this year, we've had the AI scare. In the previous cases, the index has bounced back, and we think we're going to see a similar movement over time in 2026. It doesn't mean that every company is going to bounce back. There probably are some legitimate concerns for some companies in the digital space if they don't have a good competitive edge. But when we look at companies or for companies in SKAGEN Global, we spend a lot of time and effort to identify companies that have strong, resilient moats, companies that are very hard to compete against, and that certainly can't be wiped out by an AI app or something of that nature. So we think this is going to come back, and that's going to be good for the fund. We use this opportunity now to accumulate more exposure in this area. If we then take a look at the top 10 list, kind of just to put some numbers to what we're saying here, we can start with the valuation of the fund. The PE ratio here, you can kind of see the fund in dark blue and the index in green. We are trading almost at the same multiple, not a very big difference. And we think that is a sign that SKAGEN Global is significantly undervalued, because the quality of the companies that you get is much, much higher in the fund on average than it is in the index on average. So look here kind of at the operating margin. The EBIT margin is twice as high in SKAGEN Global. If you look at the return on equity, it's also significantly higher than in the index. And the balance sheets are virtually as good, if not better, depending on the metric you're kind of looking at for SKAGEN Global compared to the index. So to us, this is a sign that the portfolio is now trading at a very attractive level. And last but not least, we have the upside in the fund. It is showing here 56% over the next 3 years. This number may actually be even a little bit higher. We are in the process of updating some of these price targets, and I wouldn't be surprised if the portfolio upside at the end of the day turns out to be kind of in the low 60s. That seems reasonable to us. So to then wrap things up here, and the key message is number one, we have seen an excessive hit to the portfolio and to the fund from this AI scare. The reports from the companies that we have seen, they have been solid. We haven't had any companies issue profit warnings or balance sheet problems or other scandals by any means. They have been performing operationally and financially exactly as we like them to be. And we think therefore that this is a sentiment-driven sell-off that is disconnected from fundamentals. Number two, the fund looks compellingly valued. It is undervalued in our view, and we're not the only ones who think that. I mean, we saw that the insiders, they have been buying their own company stocks. We have seen additional buybacks from companies. We have talked about RELX, but also Brown & Brown, Thomson Reuters, MSCI, Abbott Laboratories. Those are all examples when we have seen additional buybacks and or insider purchases on the open market. And number three then, I mean, we have experience, we have discipline. We're not gonna panic and make some drastic sort of moves. I mean, we are staying true to the philosophy of the fund. We have a differentiated portfolio from the index, so we will have a different performance both on the up and the downside. But one thing to point out is that we have very high alignment with our clients. The PMs are invested in the fund, just like the RELX management are invested in RELX. We are invested in the fund. We want the performance to go up. Of course, we'd like it to go up as soon as possible, but we also know from experience that it takes time for these sentiment-driven sell-offs to reverse. But when we look back at the fund, hopefully in a few months or a year or two, it's going to turn out that this was a good time to be in the fund, and that the performance going forward will be attractive or very attractive for the fund unit holders. So with that, kind of rest assured that we will stick to the philosophy. We will be consistent. We of course remain pragmatic. We will look for opportunities, but most of all here we will continue to support the companies that we have and make sure that we have the most attractive portfolio ready at all times to be out there in the market. So with that, thank you for your continued support, and any questions, feel free to contact any of us here at SKAGEN, and we will be happy to answer them for you.